Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Surbhi Upadhyay. It's a Tuesday morning and the going is steady. So after hitting those record highs yesterday, markets are consolidating, just spending some time, when it comes to the large cap indices. But the mid-cap action continues to be fairly robust. The mid-cap index is up 0.5%. The advanced decline ratio is positive. Not as fantastic as yesterday, which was almost 8:1. But even today, we're holding on to about a 2:1 advanced decline ratio. And there are so many individual stocks which are flying around.
No, absolutely, Reema. I think right now I'm matching at least half the screen, which is the red part. But let's see how it turns out. It's still early in the day. The Nifty bank, I must add, has actually recovered from the low. So it's not all bad. Considering the opening low and then we had that bit of a gash down from there, the Nifty bank is trying to find its feet. The Nifty is the one that seems to be struggling even at this point in time. So just before I get to some of the mid-cap movers and shakers, let's talk about what the pressure points are for the Nifty. Like I said, banks are not really contributing. And all of them actually, ICICI Bank, Axis, Kotak Mahindra Bank, all of them are stacked up at the bottom side of the screen. So that's one area of concern. Reliance is not firing, and it hasn't been firing last couple of sessions. So today is no exception, down about 0.5% on Reliance. And then you have some of the names from IT as well. Infosys, for instance, is down. HCL Tech is down about 0.5% as well. And a lot of the auto stocks are continuing to cool off after the auto sales numbers. The exception has to be Bajaj Auto. Stellar commentary, good-looking numbers, talking about an export recovery, talking about market share increase on the EV side. And look at that stock marching away towards the 10,000 mark. So that's the Bajaj Auto. However, like I said, the action is a lot about specific stocks in the mid-cap universe. And I just want to pick up some of them which are moving either on news or on brokerage commentary. And just look at the kind of gains that are coming in. So it's telling you that the market's attention now is back to mid-caps and small caps. Aditya Birla Fashion and Retail, and we'll tell you more about this. This is really the stock of the day for all kinds of reasons, and we'll get into it in just a moment. 14%, near 14% rise on an Aditya Birla Fashion and Retail. Its peer company, the other group company, Aditya Birla Capital, is having a field day as well. 8-9% up on Aditya Birla Capital, and that's because of a brokerage note that's come in. One of the foreign brokers have initiated coverage, and they're sounding very optimistic about this NBFC. We'll tell you more about it as well. Then there are more names. Uflex has commissioned some fresh capacity, 9% up on that stock. Data Patterns is up 5.5%. Jefferies is quite optimistic on a bunch of defense stocks. Data Patterns is one of them. It's 5% up over there. BEL is up about 4.5%. A mix of company corporate news and brokerage commentary is, getting stocks really excited. But before we move on, a word on Tata Tech, Reema, because that's one where there's a big development, a tie-up with BMW.
They're tying up with BMW. Why it's so positive is, if you remember, Tata Tech, the big risk from, the investor's point of view was its dependence on the Tata Group for revenues, right? Whether it's Tata Motors or JLR. So they used to get more than 30% of their revenues from the Tata Group. Now they've tied up with BMW. The size of the deal is not known, but what they have indicated that it will be a joint venture, 50-50%. So both of them will make that investment in it. They are looking at software development for the vehicles of BMW, but also the entire digital transformation. Size of the deal is not known, but just going by the fact that the company has said in its press release that at the onset, we will be staffing 100 people, 100 of our people, employees on this particular JV, and that number will go up to 4 digits. That's 1,000 plus. Just gives you an indication that this could be a fairly potential deal, a large deal, and that's the reason why Tata Tech is so excited in trade. But let's okay, we'll get to the big story then. That's Aditya Birla Fashion and Retail, which has gained 10% after it said it will evaluate the potential demerger of Madura Fashion and Lifestyle Business, which owns brands like Louis Philippe, Allen Solly, American Eagle, into 2 separate entities. After the completion of the demerger, the company plans to raise some growth capital in the next 12 months. Abneesh Roy, Executive Director at Nuvama Institutional Equities, now joins in with his initial thoughts. Hi, Abneesh. Lay out the, for someone who's not been tracking this story, tell us the importance of this demerger and how do you view it?
Yeah, thanks. Definitely, this is a positive development. We were expecting a sharp reaction to the stock today. So good to see a 12-13% up move. We think there is more headroom for the stock to do well in the near term and over the longer term because of the development which has happened yesterday. I would say that this is somewhat similar definitely to what ITC did with the demerger of its hotel business. In Aditya Birla Fashion also, there are 2 very different businesses currently housed in one entity. So we'll get a very focused play of the lifestyle business, which is the Madura. that is the more exciting business for us, and I think for most investors, because that's obviously having those very strong 4 lifestyle brands, better return ratio of this part of the business, more predictability, more right to win. The leftover part of the Aditya Birla Fashion post the demerger, that will have the more retail businesses, the more competitive business of, say, pantaloons and Style Up, etc., and the ethnic business and the luxury business. That part of the business, we need more clarity on what will be the fundraise, because that will need more capital, because that's more of retail. It is in funding stage currently. So I would say clearly investors will be excited about this. The stock has gone nowhere. It is quite cheap. 25,000 crore market cap with a 2,700 crore debt with just 14,000 crore of revenue. So it's quite cheap. If you see, Trent has done so well, 7 times the market cap, and around a few years back, market cap of Trent and Aditya Birla Fashion were very similar. So this is a good corporate restructuring exercise. Of course, this will take a few quarters. We need to know how the debt levels will be allocated, the 2,700 crore debt. But this is a positive step to give a very focused play to the investors.
Okay, just to, Abneesh, hi, good morning. Just to understand, AB FRL always had this whole bunch of businesses under it, right? Bunch of brands under it. So now with this demerger, is the understanding that sort of the better performing brands with higher EBITDA, higher margins, they get moved out into Madura? Is that the way to look at it?
Yes, that's absolutely correct understanding. So Madura will be the bigger part of the business in terms of sales and profits. It will be better return ratio business. It will be more stable business because it is obviously the branded part of the business, Louis Philippe, Van Heusen, Ellen Solly, Peter England. It will also house Reebok, which could be a turnaround story. And of course, the innerwear Van Heusen is also listed here. So this is obviously much more branded, less retail because it is sold across the retail options, while the leftover portion will be the more competitive segment, but there is opportunity to really upsize and upscale from the unbranded to branded. And the ethnic, clearly there is good opportunity against Manyavar, and they have done a lot of acquisitions. The group has done a lot of acquisitions there. So I would say, yes, that's the more difficult part of the business. But if the funding is available, I think that will become more faster growth if the execution is correct.
So how would you value the two entities now, Madura and Aditya Birla Fashion Retail? What's the thought process?
So one is, of course, the stock is quite cheap as a consolidated business. Also, if you see on a 14,000 crore revenue, it is just 25,000 crore market cap with a debt of 2,700 crore post the GIC infusion. So the issue till now has been that SOTP valuation was not done. So the cash guzzling business, the less profitable business was not getting valued at a different metric. What will happen now once we have more clarity on the timelines and on the approval? We will move towards essentially SOTP. Currently, how we see, we have a target price of 275 before this event happened. And as the quarter results come and we have more clarity on how the debt levels, etc., get allocated, I think definitely our target price will also essentially get recalibrated. But in the current 275, you see bulk of the value will lie in Madura because that, as I said, is the more attractive part of the business. But yes, currently, if you see as a consolidated business also, it is hardly 10-11 times EV EBITDA. And in terms of market cap to sales, again, it is quite reasonable. So this stock could read it, but SOTP valuation is something which will be needed because two very different kinds of businesses are there.
Abneesh, just stay on. We want to get to your valuation numbers and actual targets and how they might move in just a bit. But let me first bring in Mangalam because, honestly speaking, he's the one who flagged this off. It was always there to see, but the difference was stark and glaring. The rise of Trent, whereas Aditya Birla Fashion and Retail was absolutely sulking with absolutely zero investor interest almost. So Mangalam, I don't know if the company heard you in that earlier link or what sort of triggered this, but I guess investors are looking at it very, very favorably.
So far, the investors are looking at it very favorably. Whether the company heard me or not, I mean, I wouldn't give myself that sort of importance. But tell you what, just to understand whether this vertical demerger that the company is evaluating, will it unlock value or not? Let's talk about what the business is first and then what it means really for both the separate listed entities going forward. So this is the question that we're asking, if this exercise can actually unlock value. So let's look at the exercise and some numbers. As per the company's statement to the exchanges, what will each business hold? We have Madura Fashion and Lifestyle, which will hold brands like Louis Philippe, Van Heusen, the underwear business out there, Peter England, Alan Solly, American Eagle, Forever 21 and Reebok as well. Whereas the remainder, ABFRL, will hold Pantaloons business, the massive ethnic wear portfolio that they are growing, the fast-growing luxury brands and some of their digital brands, which are known as Tomorrow as well. So if you can look at these two businesses, you can classify them as one, which is a value generator, and the second one is a growth generator. Let's talk about both their numbers. Madura Fashion and Lifestyle brands, for the first 9 months of this year, revenue has grown around 5%, close to around 6,300 crores in terms of top line, margins of 15.5%. Whereas the other business, Pantaloons, will have revenue growth. The first 9 months, the revenues have grown 21%. And because it is in investment mode, the reported EBITDA margins are just under 8%. So one of them is a value driver, the other one is a growth driver. Now, assuming the current growth rate continues and with some additional kickers coming in from improved consumer sentiment and business focus for the next 2 years, if AB Fashion and Retail, which has grown 20% in the first 9 months, compounds at 22% on the revenue and 25% on the EBITDA, and Madura Fashion, which grows at around 10% over the next couple of years and 12% on the EBITDA, you are looking at a revenue of 10,000 crores, roughly 9,700 crores for AB Fashion and Retail on FY26 with an EBITDA of almost 800 crores. For Madura Fashion and Lifestyle, you're looking at revenues of close to 11,000 crores with an EBITDA of almost 1,800 crores at a margin of 16%. The question then is how to value these two entities, right? Looking at comparable numbers for companies like Trent, it would be prudent to ascribe a huge discount to Trent, which currently trades at 45 times FY26 EV to EBITDA. And if we give it multiples similar to players like Arvind Fashion, etc., at 20 times FY26 EV to EBITDA, the fashion and retail business, which is the resultant business, will be close to 16,000 crores in terms of enterprise value. And Madura Fashion and Lifestyle at 15 times would be close to around 27,000 crores, taking the total enterprise value of these companies to 42,000 crores. So that's the valuation unlock that we're looking at as against the current enterprise value of close to around 25 to 26,000 crores itself. But the question is, what are the factors that we're watching before jumping to further conclusions? The first one, what is the cash on books post the recent GIC fund infusion? What is the total debt and payables? Because as of September, it's close to 9,300 crores. How will this be split in both these companies? The expected growth capital infusion in ABFRL, and finally, the path to profitability and growth of both divisions are some of the questions we need answers to before we try to look at, evaluating the value unlocking decision that these companies have taken.
Okay, Mangalam, thank you very much for that. Avnish, just to come back to the discussion that we were having and taking forward what Mangalam has also put on the table, if someone has to buy one of the two businesses, right, Aditya Birla Fashion or Madura, which one would you lean towards and why?
Yeah, I think that's a easier question. I think most investors we have also spoken to, and as an analyst, we also feel Madura, which is the lifestyle business, is a far more attractive part of the business because of 3-4 key reasons. So clearly, this will not need too much of dilution because this is a better cash flow, better return ratio business, better margin business, and more predictability. While the leftover business will need cash, and they have already announced that post the demerger, after that in the next 12 months, they will have a fund in infusion, which will need to dilution. Second, of course, is that part of the business which will need dilution is far more competitive. You name it, every player is present very aggressively there. Reliance, Trend, Shoppers Stop, and a lot of the online fashion, everyone is very aggressive there. That's more competitive. While the lifestyle is clearly far more right to win with very strong brands also. So that's more like a branded business. Madura is more branded business. So clearly better return ratio, no risk of dilution, and a option value of Reebok getting turnaround. So that's housed in Madura. I think that can easily get funded through Madura's internal accruals.
Yeah, Avnish, I guess the beauty with Trent was that they made what was perhaps traditionally supposed to be a wholesale business into a branded business with Zudio. I mean, it is one of the biggest brands that they ended up creating at the mass level, right? So just to understand, I'm sure you'll be reworking targets and as this demerger plays out, but What is the SO? I mean, what was your target on Aditya Birla Fashion and retail earlier? And now with the new development, what is the kind of SOTP value you are ascribing to it?
Yes, so we had a target price of 275, and we were valuing obviously the combined entity at 12 times EV EBITDA, which is quite reasonable. As Mangalam also highlighted, for the peers, if you see, it could range between 20 times to 45 times, 20 for Arvind Fashion and 45 times for, say, Trend. So definitely there is a case of re-rating versus 12 higher for Madura part of the business. My sense is for the leftover business, I think clearly the metric will be more in terms of, say, either EV to sales or different metric. We'll need to see when the actual demerger happens. This will take a few quarters, so there is no big rush currently. But clearly today's up move is one step. I think there will be more up move in the stock in the medium term based on how the approval comes when we have more clarity on how the debt of 2,700 crore at the combined level, how that allocation happens, what will be the kind of inventory and that allocation, what will be the kind of fundraise, say, in the leftover business. So yes, I would see that more upsides will be there. This is not the end. Today, this is a sharp up move, but still I think huge comfort on valuation is there. And we will see on the target price as the approvals come.
So just one quick question. I think Mangalam put out a number that Trent is trading at, I think, 45 times, forward multiple, FY26. Going ahead, what could be the valuation multiple we could ascribe to Madura based on your assessment? It will trade at a discount because Trent has proved itself. The numbers are larger. But what could be the, going forward, the fair valuation multiple you think Madura could trade at?
Yeah, in the past, if you see, we have seen that these kind of businesses, if it's a focused play, it could definitely trade at a higher multiple. So it was just that we were not doing SOTP and most part of the investors also were not doing SOTP. My sense is Madura should trade closer to the 20 times multiple. I think the Trent is clearly a different class altogether, very focused, more of obviously it's a private label. So very focused, very little advertising, hardly any sales season kind of a model. So it's a different model. But yes, versus 12 times EV EBITDA multiple, can Madura get a 20 times EV EBITDA multiple closer to the demerger? I think that's a journey which will happen. And I would say that kind of a number is possible if the execution really picks up. Of course, here there is a Reebok kind of a option value, but initially that will need funding. So we need to...
So 20 times, Abhinish. So Abhinish is saying Madura 20 times and the leftover business, the one that houses Pantaloon and the others, what would the multiple be for that?
Yes, currently we have not moved to SOTP because this is something which will need approval. It will need a few quarters. But my sense is there can be at least 70-80 rupee there also possible. Currently also, if I see 275 target price, which we have as of yesterday, before this event, I think bulk of the 211 rupee was coming largely from the Madura part and the balance was coming from Aditya Birla Fashion.
Okay. Got it. All right, Abhinish, thank you very much. Good perspective. Good to have you on the show today. And we look forward to more conversations on this as more clarity emerges and we realize how the market is willing to value the new Aditya Birla Fashion and Retail along with Madura. We'll take a break on that note, come back on the other side and we put the spotlight on the auto sector. Most of the monthly sales numbers are in. So what's the picture looking like and what lies ahead for stocks? Abhishek Gaushande from Sharekhan by BNP Paribas will join in with that discussion. Welcome back. It's all about the mid-cap market. The gain over there is almost 0.8% right now. Very, very smart market breadth. The Nifty is not bad, actually. It's trying to recover from the lows. So let's see if it moves to the green side as well. Now, as promised, let's put the spotlight on the auto sector. The sales numbers for the month of March are in, and they seem to be a mixed bag. For some of the companies like commercial vehicle makers like Ashok Leyland, for instance, there's actually a dip. For Hero, there's a bit of a dip. But Bajaj has done exceedingly well. Escorts, Kubota and Mahindra saw tractor sales dip. So basically, it's really all over the place. So how should we read the composite picture? And in terms of, shareholders, what's the outlook? We've got Abhishek Gaushande, Deputy Vice President of Research at Sharekhan by BNP Paribas, to help us navigate some of this. Thank you very much, Abhishek, for being with us. So let's start first with two-wheelers and just analyze the trends there because they are among the strongest performers, right, in the last couple of months. What did you make of the slight disappointment on iSure? And even Hero didn't have a great month of March, whereas Bajaj Auto is now talking about an exports recovery. So the sales, the outlook, and how do you marry that then with the stocks and the valuations? Because a lot of these stocks have run up a lot.
Yes. So broadly, if you start with the two-wheelers, then the two-wheeler has definitely disappointed in this month, and we believe that there are three factors. One is that even though the wholesales was down, I believe that the retail was also lagging the wholesales, as there were two long weekends in the quarter. In the month second, that the Holastic has been followed in the northern part of the India and some of the rural regions. So because of that, I believe that the retail sales would be lower than that of the wholesales. Other than that, the trend is still continue, that the premiumization trend is still continues. This entry level segments are still lagging, and I consider that till the rural recovery will not come out, we will not see a sharp bounce back in the retail sales. And even though that the export has been expected to improve gradually, only because one of the largest market, that is Nigeria, has not come back. So considering that, even though Hero Moto in the month of the March, Bajaj Auto has outperformed the pack, and Hero MotoCorp has underperformed. But what we believe that in the coming month, when this Chaitra Navratri and the Gudi Padwa will be there, we will see a lumpiness in the retail sales, and that would help out the dealers to release the inventory. So considering this particular phenomenon, we believe that or considering this, that Hero MotoCorp is our topic in the two-wheeler segment, and after that we like Bajaj Auto, as both of these players are improving their presence in the electric vehicles as well as in the iconic premium motorcycle segment.
Okay, so you expect the April two-wheeler retail sales to be much better than March due to the Navratri season, coming in that month.
Yes.
So why Hero MotoCorp over Bajaj Auto? How do the valuations stack up? We can see that Bajaj Auto has, raced away in terms of a stock price performance. It's more than doubled, closer to the 9,300 mark. But how do the valuations stack up between the two? And what is the EPS growth that you have when you compare the valuations and growth?
See, in the two-wheeler pack, we have been liking the mass market players, because what we are seeing that they have already achieved both these stocks, Bajaj Auto and Hero MotoCorp. Both these stocks have already achieved their targeted EBITDA margin sense, and side by side investing in their future growth and entering into the premium segment, where especially if we talk about the Hero MotoCorp, which has a weak presence. So in that sense, we are liking both the sense. If we talk about the valuation, so Hero's valuation is still lower than that of the Bajaj Auto. Hero's, I think, trading at 17 times of its FY26 earnings, while Bajaj Auto is at 26 times, and both the valuations are justified, given that we have been observing a trend in the overall automobile sector, and especially in these two players, where the earning growth is driven more by the EBITDA margin expansion than that of the volume growth per se. So an inverted funnel kind of a pattern has been observing, where your bottom line growth is higher than that of the top line growth, even though that the volume growth has yet to pick out their peak levels. So as long as this trend will continue, we believe that the re-rating in the mass market segment will continue, and we have seen that in this year the Bajaj Auto and Hero MotoCorp, both these players have been observed a re-rating after a long period of time compared to the other premium player.
Okay, so that's the two-wheeler space. You've spelled out your preferred stocks there as well. Let's talk four-wheelers now. Maruti had a very strong March. And I think some of their newer SUV offerings are also being well received by the market. It was a little more subdued for Mahindra and Mahindra. And then, of course, we'll see what Tata Motors has to deliver as well. So on the four-wheeler passenger vehicle side, how were you positioned, and how did you read the numbers?
In the PV segment, I think the PV segment has almost performed in line with their estimates, along with the tractor segment. Although CV segment has outperformed, and we believe that along with this favorable period for the CV, the anticipated price hike from April has also resulted into the preponement of the sales, given that the Tata Motors is expected to increase prices by up to 2% from April. But what we are expecting that a kind of a moderation in the CV sales especially in the Q1 because of the union election. And in the PV segment, we expect that the mid-single digit kind of a growth would be maintained because of this euphoria on this SUV sales. So considering that in the PV pack, our top pick is Tata Motors before Maruti, given that most of its cylinders are firing well, and JLR in this month is also expected to, for JLR, Q4 used to be a strong month, and we are expecting almost 12 to 15% kind of a volume growth in JLR in the March. So considering that, it's focus on the sustainability of the margin and reduction in the net automotive debt. We are more positive on the Tata Motors in a four-wheeler play compared to the other players.
And what about tractors? The numbers look disappointing. I think M&M's tractor volumes declined 26%. For Escorts, there was a decline in tractor volumes by 17%. What's the outlook for the next 12 months?
For tractor segment, it was also expected to decline in the volumes, even though the overall total numbers for Mahindra and Escorts were almost in line with their expectations. So there is no negative surprise kind of a thing is there, because Chaitra Navratri was last year in the month of March, and this year it is into the April. So this advancement in the festive season has impacted the retails as well as the wholesales, along with the high base and weakness in the southern and the central region is impacting the tractor segment. So that is not a surprising element. The surprising element in this quarter was the higher than expected performance of the CV segment, given that it was expected that post introduction of a model code of conduct and last year's high base because of the pre-buying, we may see a sharp decline in the CV segment. That was not there. So in CV and tractor, if you see that for the month of March, CV has performed better than that of the tractor. But obviously, both these segments will see a kind of a moderation in the at least in the first half of the next year. And for tractor, it will all depend on the monsoon. And even in the best case, we estimate that it may report a flat to low single-digit kind of a growth in FY25 due to the high base of last 2 years.
Okay. Thank you very much, Abhishek, for joining in. Need to slip into a very short break. But before that, here is something that you, our viewers, should not miss out on. CNBC-TV18 presents India Exchange, where market experts, industry stalwarts will collaborate in an insightful discussion on India's economic path and the evolving dynamics of the Indian market. Mapping the macros with Citi's India economist Samiran Chakraborty, catch a jugalbandi between market veterans Manish Chokhani and Ramdev Agarwal. The return of the animal spirit within India Inc., a conversation with V. Vaidyanathan of IDFC First Bank, K.K. Mistry and Manish Kejriwal of Kedara Capital. And chasing alpha with market experts like Nilesh Shah of Kotak, Prashant Khemka of White Oak Capital and Anish Tawakle of ICICI Pru MF. Don't miss out on this. Tune in to CNBC TV 18 on the 4th of April, 5:30 p.m. onwards. Welcome back. Mitesh Thakkar is with us now to chart the technical trends and give us a few trading ideas. Hi, Mitesh. Welcome back. The Midcap Index is only getting stronger as we speak. When we started the show at about 11 o'clock, the Midcap Index had a gain of 0.5%, and it's just raced off. It's a 1% rally now on the Midcap Index, and that strengthened the advance decline ratio too. From 2:1 in the last 30 minutes, the gap between the advances and declines has increased. 3:1 is the advance decline ratio. Thoughts on the morning so far and your trades?
Yeah. Well, I think the market, is still not showing that strength or the conviction needed to get past the earlier highs. 22,520, 22,530 as an area where we've had some intraday hourly tops first in the first week of March and then in the first week of April, which is yesterday. So I think, till that breakout happens, there could be a chance of some profit booking from the earlier highs, and that would be a buying opportunity because the structure is positive. Close to 22,300, 330 zones. That would be a buy on the Nifty if you get those levels. Otherwise, wait for 25, 540 zones to be taken. And on the stock side, I have a buy on Crompton, which is showing good continuation on the upside today. So buy here with the stock below levels of 272 for targets of 295 to about 300. And Voltas is also looking like a good trade on the long side. That's a buy the stop at about 1170 for Tata Tech, 1245.
All right, got that. Midesh, thanks very much for the trades for the hour. Well, with that, let's take a very quick break. The market, as we've been saying, even the Nifty is trying to recover, but it's still a bit of a struggle. Broader market's doing much, much better. Let's take that break. We'll come back on the other side, and we will get into a fundamental conversation. Pramod Gubbi of Marcellus Investment Managers will join in. Welcome back. You are with us on Trading Hour, and as promised, let's focus on a couple of those buzzing stocks now, specifically from the defense space. BEL and Data Patterns have been doing quite well. Both of these stocks are up between 4 to 5%. Yeah, 4.5 on BEL, 5.5 on Data Patterns. This is on the back of some bullish brokerage notes. Upasna is here with the details. Upasna, tell us. So, who is excited about these stocks, and what are they saying?
Firstly, let me start with BEL. The company has reported its FY24 provisional numbers, and the sales turnover stands at 19,700 crores versus the guidance given earlier, which is almost around 20,000 crores. On a YoY basis, there's an uptick of almost 13.6%, and UBS has given a buy rating with a target price of 257. It says that the FY24 sales guidance is missed, but new orders are up almost 74% on YoY basis. Well, order book stands at 76,000 crores, and on the company has given 2-year order guidance of almost 5 lakh crores, which looks conservative. It says that the stable supply chain dynamics coupled with working capital cycle and closure of large ticket orders in FY25 remain key to the continued outperformance for the stock. Well, Jefferies has also written a note on the defense stocks. It has initiated a buy rating on Data Patterns with a target price of almost 3,545 and a buy rating on BEL with a target price of 260. Well, it says that the global geopolitical tensions and India's rising focus on self-reliance is fueling order flow and revenue growth for the domestic defense companies. The government's focus on building country-to-country relation to promote exports is icing on the cake. Well, 2x growth in domestic defense spends from FY24 to FY30 should continue to drive these stocks upwards, is what the company has indicated.
Okay, all right. Got that. Thanks, Upasana, very much for the details there. So defense in focus, and a couple of these stocks reacting quite well to those notes. Let's move on to that promised conversation with Pramod Gubbi, co-founder of Marcellus Investment Managers. Pramod, great to have you on the show, and it's after a gap. So first, let me start by wishing you a happy new financial year. Just taking a cue from our colleague there who's discussing a couple of these defense stocks. Now, let me straight away cut to the chase. We know that some of these, manufacturing heavy intense themes is something that Marcellus as a house has really stayed away from. But what's the thinking now, given that the PSU rally is showing no signs of sort of cooling off, and defense stocks continue to find traction in the market as well?
Yeah, no, thanks for having me here. I don't think we have anything against manufacturing. Where it stems from is we look for businesses which are self-sustaining from a longer-term perspective. So therefore, the starting point remains the business has to generate a return on capital greater than cost of capital on a cross-cycle basis. Most asset-heavy businesses in India have struggled to do that. Having said that, there are a whole host of I would put them as quality industrials or quality capital goods companies, which are exposed to more constructive industry structures, in the sense better working capital management because of the nature of the customer base and so on. So one of the distinctions that we need to make is where the industrials company or the capital goods company is exposed to more private sector capex than public sector capex. Because historically, companies exposed to public sector capex have shown poorer fundamentals on the return ratios, working capital, free cash flow generation, and therefore our preference for companies exposed to the private sector capex. Given the nature of private sector capex in India, which has been largely absent for the last decade or so, we've had little luck in finding companies exposed to this cycle. But we're at a stage where we reckon the imperative is clear, both from the Indian economy standpoint, that the private sector takes on the baton from the government, which has done much of the heavy lifting as far as investing in hard industries is concerned. We're seeing the beginnings of that. We're seeing the beginnings of a private sector capex cycle. So we're quite actively interested in looking at businesses which are beneficiaries of that. In fact, it will be one of the more bigger themes from our perspective, looking ahead for the next 3 to 5 years. So if we have to pull out of the current situation that we have as an economy where you have a slowdown in consumption, given the nature of the global economy, exports are also slowing down. Like I said, the public capex has held strong all this while, but now given the imperative for the government to sort of reduce the fiscal deficit, which was bumped up during COVID, it is imperative that the private sector capex activity picks up. And if that happens, we will get into a much more sustainable path on the economic growth front, because that'll lead to job creation, which in turn will help consumption. And so it is a big focus area for us to find high quality industrials and capital goods companies exposed to private sector capex cycle.
Okay, so that's your big theme, right? Playing the recovery, the pickup in private sector capex over the next 3 to 5 years. So, explain in a little more detail how you will play this. Top of mind, I think it's private sector banks which come to your mind, or banks in general come to your mind, which will be beneficiaries, of this investment cycle. So, how do you pick the stocks over there and even outside of banks and financials?
Yeah, no, you hit the nail on the head. The obvious play is around private sector banks, partly because they will benefit from any sort of credit growth that will happen. A couple of the private sector banks have had a long track record in funding the capex cycle in India, at least on the private sector side. Add to it the fact that the last couple of years, the private sector banks haven't gone anywhere, making their valuations look seriously attractive from a historical perspective. You get the downside protection on the valuation front. At the same time, you get exposed to the cycle as they participate in this credit growth. There are companies in India which make machinery that goes into factories as Indian manufacturing takes off, which will also benefit from this sort of a capex activity, be it gears or machines that go into the manufacture of setting up of factories. Those would be natural beneficiaries on that front. You can look for proxies through, building materials being sold to the build out of the Indian factory base. Those could be a proxy or an offshoot of the same fundamental driver in the economy. But all of this will have to fit into our investment philosophy around good governance, capital allocation, and competitive advantages. Luckily, we are blessed with a number of such companies in India, which creates a decently large universe for us to pick from.
Pramod, hi. So just to go back to that point on industrials, and it sounds to me like it's a bit of a pivot because you're now looking at some of the high quality names where capital allocation policies are in place. So can you just elaborate on that? I mean, just drilling down a little further, because valuations perhaps have really run up. Would you be looking at larger companies, the tier one, the ABB, Siemens and the likes, where, governance, etc., probably things are taken care of, at least those aspects? So would you be looking at tier two, tier three? I'm also looking at additions to your Little Champs portfolio last 7-8 months. I mean, you've added stocks like RHI Bangalore, there is Tega Industries, there's Shanti Gears. So I don't know how much of this really classifies as pure industrials, but just trying to understand what the thought process will be in terms of stock selection going forward from here.
No, absolutely. I think valuations are an important concern, which is why we reckon that the large cap industrials, perhaps within the quality space, we would wish if they were available any cheaper. But mind you, if we are looking at a 3 to 5 year cycle, there could be plenty of earnings momentum which can justify these valuations. But from our perspective, rather than just looking at large caps, we are more bottom up. We're more than happy to look at some of the small and mid cap plays, because that's a much more wider and deeper universe. And indeed, the recent rally in small and mid cap of the last year hasn't seen much of a participation from quality plays. It has been driven off certain themes such as we spoke about defense or EMS, where PSUs or businesses doing business with PSUs have benefited a lot more. To that extent, in the smaller mid-cap space, if you focus on quality industrials, you will still be able to find good picks. And that's why you see the list on the screen. Whereas in large caps, we would hope for some sort of a correction or a better entry point or earnings momentum to pick up to the extent that we can see those valuations being justified.
Okay, all right. Slightly shorter chat, but a very interesting one. And we'd love to sort of expand on it, talk about some of the other themes as well that you're bullish on for this new fiscal. And we will do that over the next call. Thank you very much for joining in today. Well, with that, we do have to take a very quick break. We will come back on the other side and get you more on the markets and, of course, some updates as well.
Welcome back. Let's get you some important opinion coming in from the government. There are no restrictions on importing cars from China under the new EV policy as long as companies meet the investment and the other criteria. That's the word coming in from Rajesh Singh, Secretary at the Department for Promotion of Industry and Internal Trade, DPIIT. Speaking to Parikshit Luthra, Mr. Singh said the new EV manufacturing policy has received strong response from global EV makers. He also said that he has advised all government departments to disperse production-linked incentives on a quarterly basis.
There have been some cases where the claims made have, led to certain queries being raised about the quality of the paperwork and all that. That has created some discomfort, and therefore, maybe in certain cases, the processing has not been as fast as it ought to be. The government and the beneficiaries have to work together to ensure that that process improves. What government is hoping to do in the future is to increasingly create a situation where quarterly disbursement of incentives takes place. We are also looking deeply at the SOP itself and trying to ensure simplification where required. And finally, on the specific issue of the auto PLI, my understanding is that several companies in different categories have now met the investment threshold. The SOP will hopefully follow shortly, but I don't think the incentive claims as such have started coming in there. I don't think the SOP will prevent us from meeting those incentive claims. In the case of white goods, which is done directly by DPIIT, we rolled out the entire disbursement for the current year of about 65 crores. We actually released about 71 crores on the basis of the claims made. So it's not it's something that we are closely tracking, and we intend to ensure that business gets the incentives that it has claimed to in a reasonably quick fashion.
What about the jobs? How many jobs have been created on the ground as a result?
So let me try and dig out that figure for you. The target up to 22-23 for employment was 4,25,000 odd employment. What was achieved in up to 22-23 was 3,66,000 employment. For the 23-24 period, the target was 1,91,000 jobs, out of which till December, and we, of course, 3 months, we've just now ended the financial year, but I have figures only up till December. Till December, the figure achieved against the target of 191 was 1,27,000 employment. The cumulative achievement is 4,93,492 against the cumulative employment projection of about 30 lakh. So even that is cumulatively on track, but there are shortfalls or overachievement in certain sectors.
I'd like to ask you, will there be any kind of threshold or criteria as to where you can actually import from? For example, if a company which is making an investment commitment wants to import from its plant in China, can they do so?
We haven't, I mean, see, as of now, there is no, restriction on import from China per se. You would have seen BYD vehicles are already on the road after paying the relevant, import duties. So we've not, the only restriction that exists in India is on the investment side, where we have Press Note 3 and we have a restriction on land border countries. So yeah, FDI from that area is difficult. Imports from that area is theoretically possible under the present regime. Whether we'll necessarily keep it that way, I can't take a call. But as of now, under our existing policies and regulations, imports, there is no restriction on imports as such, subject to paying of relevant duty. And there's no reason to believe that any restrictions of that type are going to be applied. The restrictions that exist are only on FDI.
In terms of hybrid vehicles, there has been a lot of discussion in the industry about lowering of taxes on hybrid. What is your view and where are the consultations within the industry?
DPIIT's view has been, and this is again a subject of the Ministry of Heavy Industries, they can take a final call on this. Our view was that there is a space for hybrid vehicles potentially to the extent that they also provide some degree of fuel efficiency, reduce fossil fuel dependence, and therefore they need not be kept from a tax standpoint at exactly the same level as a pure ICE vehicle. Maybe they can be given some concession, not as much concession as the pure electric vehicles. That was our view. We've conveyed that to MHI. MHI can take a final call on that.
All right, on that note, we'll take a quick break. Coming up on the other side, the latest weather update with Manisha Gupta as IMD is predicting above normal temperatures between April to June. Welcome back. As promised, let's tell you about what possibly is going to be a really sizzling summer. Manisha is joining in, and she's been, of course, looking at all the commentary that's coming in from the IMD. So is it going to be really hot this time around, Manisha?
Well, it looks like it's going to be a long wait for the monsoons to hit because you have April and May in middle before the monsoons hit in the month of June. And as per the IMD, the latest report that has come in does confirm that in the last 1 week, there have been above normal temperatures to the tune of 40 to 42 degrees that was recorded in West MP, Bengal, Andhra Pradesh, Gujarat and Maharashtra as well. When you look at the month of Feb and March as well, Southern Peninsula has seen the highest temperatures coming in there. The maximum temperatures in past 1 week have been recorded to the tune of 42.6 degrees, and this has been in Akola in Maharashtra and Palodi in Rajasthan. So we are looking at higher temperatures already. And IMD now has predicted that for the month of April to June, there is a high probability of heat waves persisting anywhere between 10 to 20 days. This is much higher than 2 to 8 or 10 days that we see in sense of heat waves or above normal temperatures coming in. So the states which could be looking at harsh and arid summer are Rajasthan, Gujarat, Maharashtra. We already are looking at higher temperatures here. Then you have Odisha, Karnataka, Andhra Pradesh, much of the southern states as well. So whether it's about Tamil Nadu, Karnataka, Kerala could also be looking at higher temperatures within these 2 months. For the next 5 days as well, the IMD has put out a report suggesting that you could be looking at warmer temperatures coming in for MP, Tamil Nadu, Andhra Pradesh and Karnataka also. Importantly, interesting to also read within this report is that for the month of April, the pre-monsoon rainfall is also estimated below average. And so coastal India or East or South India for that matter could be looking at lower rainfall here. Going forward, because the El Nino is receding, so the monsoon that hits in June and continues until September is expected to be as of now normal. But remember, that is one report that IMD will come in by mid of April, around 15th to 17th. And that is a date that we will definitely be keeping a keen eye on.
Okay, thank you very much for that. The summer heat is going to only intensify. We're going to wrap up on Trading Hour on that note. Stay tuned. Halftime report is up next.